I'm gonna keep you up. I'm gonna keep John up here. And if I did I mention that John has a book and a book in the back of the room? I might have mentioned that, right? Oh, they're all gone. Well, I have two up here, so we might raffle them off. I got $2 up there that I might raffle off. See, I'm a trader. I traded that, and I kept 2 books up here. So I'm going to bring up also a colleague of mine and a friend, Dr. Alan Ellman. Please come upstairs. Give Alan a rounding applause here, as well as John. Dr. Ellman, who some of you went to go see already, is president of Blue Collar Investor. He's been trading stock options since '85. He's got tons of books, and I'm going to pass the water to both of you gentlemen there, and we are going to make this a little bit interactive. But let me start off by just mentioning that unfortunately Marcus is not here, and he had a family emergency, and all of us at the Money Show and such we're sending thoughts to him and his wife. So, but what I'm going to start off with, I'm going to channel Marcus, who said something to the three of us, which was that how can anybody make money? You just were talking about the volatility. We're going to come into Monday here. It's a crazy market. Let me start off with you, John, Alan, then I'll go to you. How does one in the options world potentially capitalize on this craziness?
Yeah, it gets a little trickier with options when they get this expensive. So you'll see something where the VIX has now gone from about 18 to 40 in a very short amount of time. So option prices have inflated. Well, the really tough way to make money in an environment like this is directionally, in terms of, I think this may go higher. So let me just buy an at-the-money call, or I'm going to go lower. It's going to buy an at-the-money put. Well, the moment it just starts to pause a little bit because it's pricing in such a big move, a premium can evaporate very, very quickly, especially if it's like a 0 DTE type of an option. What I do like on this, if you're going to do something directional, because the moves have been so big, is that you can do, so for example, on Monday, if we have a margin call Monday puke down, I would look for some kind of far out of the money call debit spreads for Friday, like on SPX, things like that, and just be willing to risk the debit. But you can go far enough where if you can get a debit that's maybe 20% of the width of the spread, at some point, if you get some just kind of crazy snapback rally, then it's going to benefit. But otherwise, you just want to be, it's really about, in a situation like this, it's really just about, you've just got to have asymmetric risk involved, meaning it's that you're going to risk 1 to make 6 or 7, and then that way you don't have to make as big of a bets.
Perfect. And Alan, blue collar investor. So your thoughts, again, markets that are kind of unprecedented after Thursday and Friday. So your thoughts for an audience who are most likely probably option traders coming into Monday and then looking out towards the week.
Okay, well, first of all, I'm on the sell side of options. I frame it in my presentations. I'm the casino. I'm not the player sitting at the slot machine. The strategies that I use are covered call writing. You buy a stock, you sell an option, allowing some unknown person to buy your shares at a price that you determine by a date that you determine. Selling cash secured puts is the opposite. You're selling someone the right to sell their shares to you. Now, I've been using these strategies for 30 years now. And generally speaking, in normal to bull markets that's up 8 to 10% a year or greater, or even in consolidating markets going sideways, I craft my trades in a certain way that will benefit the fact that I can generate premium plus potential share appreciation when I'm selling an out-of-the-money call. However, the last 2 months, I've been crafting my trades completely differently. Just as a quick example, if I buy a stock at 48, typically I might sell the 50 call for $1.50 or $2 a share. But in the more recent market conditions, I've been selling in-the-money calls, where I get an intrinsic value component to that option premium, which will then lower my break-even price point even more. Now, as far as cash secured puts are concerned, I've been going deeper out of the money, which will also lower your break-even price points. So the takeaway is the following. In certain market conditions, you can craft your trades to generate a certain percentile return. In dangerous market conditions, volatile market conditions, Unknown, uncertain market conditions like we're in now, we would craft our trades more defensively where the returns would be lower, but we have greater protection to the downside.
Fantastic. I'm going to bring up a date for John that might resonate with some of you that follow him. And for those that didn't attend the master class, I will tell you, for your next Money Show, absolutely do that. Really think about that. So sitting in this class, you talked about a date, January 14th, 2014.
Okay.
Why is that date important? And I think it kind of also, it's an overlay, no pun intended, to this discussion of something going on in the market that gave you an opportunity maybe.
Yeah, so my trading career has been focused more on, it's a combination of directional trades, but looking for opportunities where you're going to get what's just simply called a greater than expected move. So 70% of the time, stocks kind of stay within a range. 30% of the time, they can kind of break through that. And then there's a smaller percent of the time, about 5%, where they can just break resoundingly through that. And typically, you got to have a combination of special circumstances, high short interest in the stock, something earnings related. So this was Tesla, and this was way back before it even split. So it was a $150 stock, give or take. And I remember on that day, I happened to be watching it. It was down 10, 15 points. And I went to the kitchen to get something and came back, and it was positive. It's like, what happened? Elon Musk tweeted something. The stock had 40% short interest. The volume was off the chart. So I just started buying calls at the money, at the money, at the money for the next week. And at some point, you just kind of realize, like, okay, there's something here. Like, there was no drop in the price. Kept going, kept going, kept going. And pretty soon, just to be clear, I had probably too large of a position in the stock. But I had a pretty tight stop on it, and it just wouldn't come back. And it ended up being the biggest trade at the time, and it was just over $1.2 million on options. And this was something where, and I remember this because at some point you realize that, you know, when it's up a lot, you're like, I don't want to lose this. And there was a moment when it started to pull back, and it's like, gosh, I should just get out of this. This is like one of the best trades that I've made. But I had also been working with Mark Douglas a lot. He was we worked as a trading coach, and he just said, look, when you get in those moments, just get present and follow your plan. And my plan was, I'm just going to trail this 21-period moving average on a 15-minute chart, and it didn't hit it. And then I remember that we got up into the close, and sometimes on a day like that, you know, you can kind of get this spike into the close. I sold half the options. Held half overnight, didn't sleep at all, woke up the next morning, it gapped up, and I sold the rest. But it was interesting because that's an unusual situation, right? This is not normal. But it also made me very interested in trying to find more unusual situations. So it's a combination of, all right, what are some steady income generating strategies, iron condors and things like that, but then looking for what constitutes an unusual situation. And so what I like about the current market that we're having is it's an unusual situation, right, and it can create very interesting opportunities.
And on that theme of unusual, doctor, I get to say doctor, which is wonderful. We talked a little bit about this. What do you do when a trade turns against you? You know, we're talking about CSPs, cash secured puts, and because the price of that stock drops dramatically. So okay, elaborate a little bit on that.
Yeah, well, first of all, you have to have a plan in place before you enter a trade. In other words, there are certain things that we know can happen. The price of the underlying can go to the moon. It could drop precipitously. There could be earnings report dates in there, ex-dividend dates in there. What do we do if these situations come about? That plan has to be predetermined prior to entering a trade. So let me give you a quick example. For covered call writing, once again, you buy a stock, you sell the option. You sell the option for a certain premium. Let's say it's $2 a share. Let's say we're going 1 month out. Now, our enemy is the price of that stock dropping below the break-even price point. If it goes up, we're good. If it stays the same, we're good. If it goes down a little bit, we're still good. But if it goes down a lot, that's where we can end up in trouble. So how do we plan for this? Well, in the 1990s, when I was teaching myself these strategies, I got hit over the head a couple of times with declining stocks. I did, just like everybody does. But I said to myself, what could I have done to mitigate this, to avoid this? And I realized I'd have to have a certain point in time where I bought back that call option, because you can't just sell the stock. You'd be in a naked options position, which most brokers won't allow us to be. I have to buy back that option. At what price do I buy it back? So I started fooling around with different percentiles. It took me about 3 years, and I came up with what I call in my books the 20%, 10% guidelines. What that means is the following. If the price of the option drops by 20% or more, no, up to 20% of what the sale price was, we automatically buy it back. So here's how it works. Buy a stock at 48, sell the 50 call for $2. Immediately after entering that trade, put a buy to close, good till canceled limit order at 40 cents or less. That stays there until you remove it or the option expires. If the price of the stock goes down, it'll bring down the value of the premium. The trade will be executed, and then you say to yourself, okay, what do I do? Do I roll the option down? Do I wait to see if it recovers and resell the same option? Do I sell the stock? You have to have a plan in place. So the 20%, 10% guidelines are critical, and if you sell a deep out of the money cash secured put, and in my strategies, if it drops 3% below the put strike, well then you just exit the trade. So you have to have a plan in place, whether you use my guidelines or you have those of your own, but there has to be a plan in place.
It's great advice. I mean, this whole idea of planning, and I'll transition you, John, on this. You talked, again, at the masterclass about the excitement of trading, and then, we look at being either, sort of long, short, or when are those times when you're going to be sitting in cash because you're waiting for that exciting moment to get back in the market? I think you just talked a little bit about where we are in the charts.
Yeah, and there's one thing, at least I've noticed, I don't know if anybody else has noticed this too, but you can be in cash, and then if you suddenly get into a large position, your IQ drops by about 20% if you don't have a plan in place. And what this simply means is that you kind of go from having a plan to becoming more your reptilian instincts of fear and things like that too. And so you want to be very, very, very careful of that. But on something like this, in terms of, you're just more focused on like an unusual kind of circumstance?
Well, more about the I'm transitioning to the excitement of trading. So
yeah, okay.
You were talking, so you're gonna be long, you're gonna be short, but where you might be sitting in that cash position because
yeah, okay. Yeah. So in like the trading account that I have, the main one that I shorter term trade. So this weekend I'm in cash. So what the idea with this then is, so there are a lot of strategies could have done over the weekend. And for example, the VIX is so high,
yes.
Just selling and at the money iron flies on SPX 100 points wide, you can get them, it's almost like a 75% credit. But when there's such an unknown like that, instead of waking up on Monday having to react, you can I kind of equate it to, if you've ever seen I have these two cats. They're these Maine Coons. They're like 20 pounds each, brother and sister. And they will sit there. We used to have animals around our house, squirrels, birds, all these things. They're just gone. And they will just sit there during the day and they just watch. They'll watch the bird feeder and they'll do that for hours. And then there'll be a bird that isn't paying attention and they spring and they pounce. And it's kind of the same as being in cash. You can sit there and almost hear the screams, in the street of what's going on. And then at some point, and I always think of it this way, it's, capitulation is a very big thing. And capitulation is when a long-term shareholder panics and gets out. So anyone that bought NVIDIA at 155 saying they're holding it forever, they're thinking things this weekend, like, am I holding it forever? And if it's Monday, if it's a long-term holder that comes in and capitulates, that's an opportunity. And so a lot of times I find that the best entry opportunities are capitulations on the other side of the trade, but you can't take advantage of it if you're maxed out worrying and trying to manage your own positions.
Eric, can I say something
Please.
about many people in the audience here find their portfolios down probably 15% year to date, 10% in the last 2 days. And if they're thinking, what should I do? Well, let me bring it home to the strategies that I use, in particular covered call writing. There is something you could do to mitigate some of these losses with very low risk of exercise and losing your shares. And that's by selling deep out of the money covered calls. In other words, agreeing to sell your shares at a much, much higher price than they're currently trading for. And that's not going to generate impressive returns at all. Because if you also want to retain your shares, maybe you own them at a very low price in a non-sheltered account, you don't want to have any capital gains issues, so you're going to be selling strike prices way higher than current market value, which means the premiums you're going to receive are not going to be that impressive. However, if you can generate another 6 to 8% a year by selling these very deep out-of-the-money covered calls with a risk of exercise somewhere between 8 to 10%, why not take advantage of that? It's very low risk. You can quantify your risk by looking at the delta of the option, approximate probability of expiring in the money, which we don't want. You can also use implied volatility to give you a trading range, and then you would get a 16% risk factor with implied volatility. So there's ways of quantifying the risk of those trades, and yet you have an opportunity to generate 6 to 8% annualized return, and at the same time allow those shares to come back in value.
So sort of it's an opportunity to lease out your house, like rent out your property, your second property, to somebody else to at least generate a little bit of income. Might not be a great rental market, but at least what you're doing is you're bringing in some income on that.
Yeah, rent to own, except you don't want to sell
but
your
you don't
house
want to sell
in that particular scenario.
Correct. You don't go into that lease agreement with your renter. Talk a little bit, Alan, about quantifying risk, because I know you talked at your session about this. You take on a trade. How's this way about being defensive? I like the idea that you put that, how you quantify risk.
Yeah, well, I just mentioned delta just a moment ago. That's one way to do it. So one of the definitions of delta, there are actually three, but the one that applies to your question, Eric, is the approximate probability of expiring in the money or with intrinsic value. So let's say, for example, you own shares of stock at a low-cost basis, and you want to write a covered call. So what you do is you check the option chain, and you look for an out-of-the-money strike. In other words, agreeing to sell your shares at a higher price than it's currently trading for you. Now, most option chains will have delta statistics in there. So you look for a delta. How much risk are you willing to take? Let's say you're willing to take 10%, right? So you look for the strike price that's showing a 10% delta. You look what the premium is, and then you put that into your spreadsheet, and that will tell you what your return is. If you want to take less risk, then you go for a lower delta, 8%, 6%, whatever it is, right? So that's one way of doing it. And the same thing with out-of-the-money cash secured puts. If you don't want that exercised and those shares put to you, look at delta. The one other way of doing it that I use a lot, and I actually developed a spreadsheet for this, is implied volatility. And without getting into the weeds of the standard bell curve and all that kind of thing, you can use implied volatility to calculate an actual trading range for that stock specific for the contract that you're dealing with and have a risk factor of only 16%. So how much risk are you willing to take? I know how much risk I'm willing to take. I don't know how much risk John or Eric is willing to, or anybody in the audience. You can figure that out, and that will guide you to the right strike price and the right option.
It's a great way to put it. Chris, I think Q&A. That's what I want to hear. Thank you for that. So we have a mic right there and another mic right there, and it looks like a gentleman is walking over to ask a question, which I'm really excited about. Please give us your name and the question.
Yeah, my name is Roderick, and this is for John. First of all, thank you for a terrific presentation, especially with no sleep. You talked about a potential Monday trade 5-to-1 debit spread. What would the expiration be on that trade?
Yeah, okay, so a good question. So on something like this, and this is where you really want to quantify the amount you want to risk. And so I look at it as a debit where you're okay if it goes to zero, because that matches, like if you're willing to lose $1,000 on the trade, then the debit's $1,000.
Yeah.
So it's kind of that way. But what you're looking for in something like this is almost like it's a contagion kind of reversal. So if you remember during March 2020, you might have 3, 4, or 5 days in a row limit down, and then you would get this blistering 3-day rally. And so we're at the point now where, yes, we could keep going higher, but we're looking for signs of, okay, are we going to get a blistering 3-day rally? So on Monday, I would look at something Alan was just talking about deltas. So something where buying a delta 30 call, selling maybe the delta 10.
Okay.
Typically on something like that, you're able to get a debit that's less than 20% of the spread, And then you could also layer into that one for Wednesday, and then one, the same deltas for Friday, which would be at a higher price. And on something like that, where what's nice about it is that if you do kind of get the rip, things will kind of settle in nicely. You weren't putting a lot of risk on the table because you don't have to. You're not worried about a stop loss because your stop loss is the debit. So it's not. This isn't a sizable trade, but the return on it is very, very nice if it works. And if it doesn't, it's a normal stop loss that you would have taken on a trade anyway.
Okay, and for those of us who maybe are a tad less risk tolerant as that, could this work with a 2-week expiration?
Yeah, absolutely. So the downside, of course, of the shorter duration is you're kind of got a small window to be right. There's the downside of going out, say, a month. It's not really a downside. It's just that you could get a big bounce and your debit doesn't move very much because the option premium really isn't eroding on that sold call. Right. But that's not necessarily a bad thing either.
Yeah, but you think 2 weeks would be okay?
Yeah, and on something like this, when we were talking earlier about reverting back to the mean, so at some point we're going to go back to that 21 period moving average. So I even like the idea of a month out, far, it could be very far out of the money debit spread that lines up around that 21 period moving average. I have found that if you're looking at something, let's talk about SPX, and you're thinking like, oh, I'm going to do 10 of these $5 wide. I'd rather do one $50 wide. Okay. It's the same amount of cash on the table. But you just get those $5 wide ones really don't do much until very close to expiration.
Yeah. Well, thank you. That's very kind of you.
Will you also come up at the end, because I have a book for you for being the first classmate to ask a question. So I've got a book for you, all right?
Appreciate that. Thank you,
Anybody
gentlemen.
else here? We have another gentleman coming up for a question, and then we're going to, will you come up to the mic, or should we bring the mic to you? Go right ahead, and then we'll follow up with the young lady there. Go ahead.
So in this kind of market, when implied volatility is so high, it's kind of tempting to sell for credit. On Monday, we are pretty uncertain what direction it's going to get. So do you think it would be a good idea to sell call and put both sides for a triangle or iron condor, this kind of thing with a short duration, for example, for a week or something?
Well, I could tell you what I've been doing. I've been doing weekly, deep out of the money cash secured puts on elite performing securities. So on my watch list of underlying securities, I only have the top performers from fundamental and technical perspectives. In other words, that are, despite the market, that is showing bullish trend, bullish momentum, and earnings and sales growth. So they have to have all those components to be on my watch list. And despite the fact that they're appreciating in value, I will still, to protect myself, sell a deep out of the money, much lower than current value, cash secured put, and the returns that I'm seeking would annualize out between 5 and 15%. So that's my guidelines for the current market conditions. Now, one of the advantages of doing options, and I don't know the time frames that John uses, but I use either weeklies or monthlies. So that means I have, with weeklies, 52 times a year to reevaluate my bullish assumptions on those underlying securities, 12 times a year with my monthly options. So I may be bullish this week and maybe not so much next week, but only the elite performers, deep out of the money. I have my trading range and my return goal range in mind, and that will guide me to the correct strike price. Now, one final thing with this question. You should always have your exit strategy in place if the trade turns against you. Or in the case of a cash secured put, what if the price of the stock turns around and goes even higher? Mm-hmm. You might be able to roll up that put option and generate additional cash. So you have to be prepared in addition to crafting your trade in a defensive manner.
I love the way you said it, because options provide options. I didn't come up with that phrase. I'll probably give that to the SIBO. We're getting close to time. I'm going to have to arm wrestle between you two for the other book. But could you give us your name again? I'm sorry.
Hazel.
Thank you, Hazel. Please go ahead with the question.
Quick question for
Don't make it quick. Go ahead.
John. You talk about 21-day moving averages. Are you talking SMAs or EMAs?
Yeah, it's a good question. And it's not critical. I happen to use EMAs. That's just kind of how I was trained. But
EMAs.
But it's going to hit both. So, but the idea is that it just becomes, if you think of it as, a reversion to the mean is that it always just comes back to what this average price is. And the average price is moving, right? But it always comes back. And so I think what I like to look for are, if things are extended, signs that the momentum is kind of leaving the building. And then that's an opportunity to, I like Alan's idea of, like, if you have a stock and you have a signal that it might come back down to the 21, that could be where you could sell an in-the-money call against your stock, maybe to protect some of that. But from a trading perspective, we've been on the far extended upside of the 21 for a long time, and we're already very far extended to the downside, and Monday we may even be more so. But if we keep in mind that it always is going to revert back to the mean, I guess, unless it's Enron, right, and goes out of business.
Or WorldCom.
Or WorldCom, yeah. But that's going to be the opportunity, and it's just being able to take advantage of it in a way where your max risk is dialed in to something that you can accept.
Hazel, my mom taught me well, so I'm going to hold this other book for you, okay? All right?
Okay.
We're getting very close to the end here. We have one more question there. Go ahead, please.
Yes.
And your name?
Wayne.
Wayne, thank
Wayne
you.
Sandberg.
Thank you.
One of the nice things about Armageddon, when the market is free falling and your VIX is going through the roof, if you take about a 2 deviation from the current price, which is around that 10 delta, instead of doing cash secured puts, what I always do is do a credit spread on puts. A 10-point spread is $1,000 risk, and you can get a $200 credit. So your risk is only $800, and you can stay within 30 days. And 2 deviation, you're already dropped 3 deviation. So another 2 deviation down, that's a 50 deviation almost from the original price when Armageddon started.
Did we get you up here to give us your strategy or your question?
I have a.
I appreciate that. I just want to know if I was missing it.
In addition to that, what I do on 35 to 45 days out and doing these spreads, I also use futures in case the market really falls. You actually make money in these free falls that is unbelievable.
Until it's
If you use a micro future on the ES, and if it comes down and you got 100 points, I don't want to go into this. I'm really going to screw you guys up.
What can I ask these gentlemen?
Mark Omans will appreciate your mention of the futures.
I appreciate that. Again, I think we're almost out of time here. So what I really wanted to do was I'm going to let you speak to these gentlemen after, because we do have a reception. I've got to keep us on time. Otherwise, I'm never going to be invited back, and I'll actually be somewhere else. So we're really close here. Thank you all. Let's give a really, really rounding applause for these gentlemen. I mean, this is...
And for managing the show today. You got to keep things on
listen,
track.
I'm only part of what's an incredible team here. I'm going to ask Chris or Debbie, whatever. So are we moving everybody to... We're going to move everybody up to Meritage, I think it is, for the reception. Those of you who want to put on your cowboy boots and hats and do some dancing with each other, we'll encourage that. But again, thank you all for staying, and we'll see you all up at the reception.
Pleasure.
Are you here in Dallas?
Florida.
Oh, nice. Okay.